Welcome to the program. On tonight's show, who are the hunters and who will be the prey in the fast-moving media consumer discretionary space? It's one of reporting season's biggest headaches to make your move before or after a company's result. We'll put A2 Milk to the test. And in our stock in a minute, a company that makes a heap when you can't pay your bills. Let me introduce my guests tonight, Kim Slater from County Securities and Michael Gable from Fairmont Securities. And don't forget, you can reach us on eq@skynews.com or hashtag equityinvestor. But let's start off by having a look at our spotlight on consumer discretionary. This sector is a big sector. It includes retailing, media, gaming, services, as well as automobiles. And I guess when I'm looking at this space, I'm asking myself, how do you choose the winners from the losers? Well, who better to ask than our panellists tonight? We'll start off with Kim. Kim, we're looking at the consumer discretionary sector. This usually has a higher PE ratio than the rest of the market, so it tends to be more of a growth area. But when you're looking at this space, obviously there's some wild valuations and wild growth rates in this sector. Well, what are some of the keys when you're looking at stocks in this space?
Very good question, Julia. Where do I start? But I think the thing is you've got to look at the businesses to see whether they're mature businesses. If you're looking in consumer discretionary, you're looking at, for instance, retailers, you're looking at Woolworths, at Coles, you're going to apply different growth metrics to a business like businesses like those than say to something like Afterpay. So it's really critical to understand the metrics of the business environment that they're operating in, who their customers are, and then look at the growth, the underlying growth rates, and those underlying growth rates will give you an indication of then what their profitability levels should be.
So that's a really good point. More mature companies tend to have a lower PE ratio because they don't have that growth, whereas the smaller companies, they have the growth in front of them, and people are willing to pay a premium now for that future growth, so tend to have higher valuations in that space. So depending on what you want?
Well, it's horses for courses. So if you're looking, for instance, if you take Afterpay as an example, which is trading on a multiple, I think it's 100 times or something or other, 2020 earnings. If you're looking for that growth and you believe in the business model, you'll pay that price. Now, someone who's a value investor is going to look at that and say, I can't justify that sort of earnings multiple because the earnings simply just haven't caught up with the growth rate of the share price.
When you're looking at consumer discretionary, Michael, what are some of the keys when you're selecting stocks for your portfolio?
Well, I guess if we start at more of the macro level, we can see we are in an environment where housing prices are coming off. Wage growth is still fairly low. So I guess at the macro level, you could make a case for tougher conditions in the future. But like any, sector, it comes down to the individual companies. Some companies are having issues trying to grow their margins. So we had JB Hi-Fi post their results today, and it was a good number for the prior year, but they're looking at sales growth for the next year of about 3.5%. And they're operating in an environment where we've got price deflation. So that could be quite tricky. Whereas there are other companies such as ARB, which is one that we're releasing a report out tomorrow on, they're still seeing margin expansion, and there's still potential for them to expand their margins. So
a really important point there, that this area is cyclical, so it is dependent on the economic cycle. It is consumer discretionary, So generally it's what consumers have left over at the end of the day to spend. They spend on things like media, gaming, or retailing. Looking at this space, what were you about to say, Kim?
I think one of the important things that you need to focus on here too is the quality of management, which often gets overlooked when people start talking about multiples and growth valuation stories and everything else like that. Because really the fundamental driver behind the business is how good is the management and the management team, because they're going to be the people executing the strategy, and if they're not up to the mark, the shareholders are going to suffer.
Okay, so we've covered on not so much already. We've had a look at valuations in this space, what stage of the business cycle, the economic cycle, which drives valuations as well. Valuations in this space are, though, huge. I mean, Kim, you mentioned Afterpay, which is technically in the tech space, but I guess just to give you a few stocks that are in the official consumer, I can see why it would be in consumer discretionary, though. The cheapest stock in this space is probably something like Navitas, which has negative earnings per share, and the most expensive at the moment is something like Kogan. So, I mean, looking at that valuation spectrum, Michael, do you prefer the cheaper stocks, the more expensive stocks? Does that play into your investment decision at all?
It is tricky to look at them purely from that valuation perspective. So you have a company like Myer, an old school company, a lot of assets generating a certain amount of revenue off those assets. And then along comes a company like Kogan, where the asset base is a lot smaller, but really, you know, in terms of the revenue compared to the assets, it's a different story. So it's hard to, I guess, value them both on, you know, the same way that you traditionally value these companies. And a company like Afterpay, I guess what's interesting there is you've got, I guess, a problem where you have price deflation, waning consumer demand potentially. So instead of being a normal company that sells stuff and tries to cut prices to stay competitive, you have Afterpay looking at it from a completely different perspective, saying, well, instead of selling stuff cheaply, let's try to go after the people that can't afford it and accommodate them. Well, so they've come in from a different angle.
The interesting thing about the Afterpay business model, when you actually look at it, it does actually facilitate discretionary spending. So from a retailer's perspective, they've suddenly got a new client base that they may not have had previously.
And so do you like Afterpay? Would you be buying it now?
With my eyes closed, I probably would, because I mean, there's a range of valuations on the stock, and you can choose a figure, and it's a bit like pinning the tail on the donkey. Will they or won't they get there? I think there's more upside in the stock, particularly now they've established this beachhead in America. But the point I wanted to make about retailing is why retailers like Afterpay is Afterpay actually increases their stock turn. So more people coming in the shop, more people buying on the Afterpay plan, which in turn creates more demand for the products that they're ordering from China. So it's Afterpay itself has been responsible for picking up a lot of the discretionary spending.
And I guess this is a structural cycle that we're riding here with things like Afterpay, the move from bricks all the way to clicks. And I guess just having a look at the Afterpay story, it is all about that growth coming through. Someone once said to me, when a product or a brand becomes a verb, that's time to buy. It's like, I Afterpaid that. Yeah. Would you be buying it, Michael?
Look, it has had a good run. There was an interesting article in the Financial Review today basically posing the question, is it a credit provider or is it a payments platform? And depending on which way you view it, depends on...
I had the same argument. I remember when Apple was $10 a share. Is it a technology stock or is it a consumer stock? What actually is it? So, to a certain extent, you've got to have... It's an act of faith investing in these stocks. So if you believe the business model, I think Afterpay does have a good model which can expand in the US. I think its valuations will stand up. But
we do need to go to our first email, but before we go, I want to get your favourite pick in the space. So, Michael, what do you like?
Oh, look, I like the look of ARB. It has come back a bit over the last few weeks.
Why do you like it? Automobile parts?
Yeah, look, there's growth in four-wheel drives is still strong. They've got the production facility over in Thailand, so costs are coming down there. They've got scope to increase their margins, and the PE that it trades at is not demanding compared to where it's been before. So I could see scope for upside with ARB.
Okay, so liking ArbCorp, and how about you, Kim?
Well, one out of left field in media, Seven West Media. Simply because you've had the merger between Fairfax and Nine. The question is, what is News Corp going to do post that? It had a crack at 10 and failed. So Seven West Media, price has been moving up. Results will be out shortly. And I think there could be an upside takeover play.
I have Seven West Media in my portfolio, so I should disclose that. Let's go to our first email of the day. This one is from Fuzia Chowdhury. She wants to know whether or not she should buy A2 now or wait for results. It's up today at $9.89. So having a look at A2 milk. Michael, what do you think?
I would wait. Look, it is at a level technically on the chart where it should bounce here, and we did see a decent move up on Friday.
Don't think that's A2 Milk's share price chart because it did finish at $9.89, not 93 cents. But
It's 93 cents or buy
you
them.
think it's looking interesting here on the chart?
Look, it's at an interesting level on the charts, but not good enough that I'd have a leap of faith and buy it. So it's starting to look a bit more positive. Obviously, they had that, the poor guidance in May, which rattled the market. There was a trading update, I think, in July, which was okay, but I think we're in that stage where we need to see that the growth story is still intact. I think there's still a lot more growth ahead of it, but I think it's in that stage where the market just wants to see another result.
I mean, there's no doubt they're growing in FY18 when they release results. Revenue is probably going to be up 68% according to their forecasts. The year before it was up 56%. I think the problem the market has at the moment, there's a lack of catalysts here. Sure, the growth is there, but where's the upside surprise? And I feel like the market needs more from some of these growth.
I think you perhaps should err on the side of caution, wait for the result, see where the result is. I mean, you might give away 5% on the upside, but for that, you'll have the certainty of knowing that you're not going to get carted out as well if there's any surprises in the result.
Okay, and for anyone who's holding A2 Milk, what would you be doing?
Look, I think longer term the story about China is still intact. I mean, it's like all of these growth stories. They get on a trajectory and they get halfway through and then they stumble. They pick themselves up and they keep going, and that's what we've been seeing with A2 Milk. So I think longer term there's still plenty in front of it.
Okay, so that was A2 Milk. We now have an email here from Zilla, who is considering selling Ardent Leisure. Zilla has made a small loss on it, but worries that it could get worse. Now, this is a difficult one. Last year, EBITDA of $1 million. The consensus at the moment is for a year loss of $57 million. The company basically predicting a loss of between $50 to $55 million. Now, we know what's happened with Dreamworld and the disaster there. But, this company is mainly Main Event over in the US. And unfortunately, we saw some write-downs which were related to that. So, Kim, what do you think that Zilla should do on Ardent Leisure?
Look, one of the largest shareholders in Ardent Leisure is Ariadne, which is Gary Weiss. And Gary Weiss is a very, very smart businessman. So if anyone can turn this business around, and they've already started to do that with that Main Event business in the US, I think there's a real chance that maybe the worst of the news is actually coming to an end, and we should start to see some positive developments as to what's going to happen. I mean, they've been basically clearing the decks from previous management mistakes. So I would tend to think that possibly we're close to the bottom on this stock.
Wow, do you agree, Michael?
We could be. I think that I just can't see any catalysts for at least the next several months.
It's a bit of a waiting game.
Yeah, so we've had that trading update. When they report, there probably wouldn't be anything new there. So I think the market will just see it drift sideways until February and so on. So I think in terms of the viewer, if she's got a small loss and there's potentially other opportunities, maybe she can do something else with the funds and wait for maybe evidence of that.
By ARB.
Yeah, exactly.
Or Seven West Media.
Because it's quite difficult trying to time that turning point for a company when it's been in that massive downgrade cycle. It could be another year. You miscalculate, you could be seeing those losses. So I guess it really depends on Zilla's personal risk tolerance and what situation she's in at the moment. Coming up, our stock in a minute, plus Kim's darling in the mining space and Michael's must sell. We'll be right back.
You're watching Equity Investor on Sky News.
Now it's our stock in a minute.
Basically for us is about the growth story in the US. The update that they gave us recently was a very positive one. It's already had the results, so the risk going into the reporting season is very limited. We think the US business could catch up to the Aussie business in the next couple of years. If that happens, we expect the stock price to be heading north of $30. So where we are in the cycle, credit card delinquencies in the US is picking up. The economy is doing really well. So I think it's a really good buy with the right thematic going forward.
couple of things here. First of all, Credit Corp has already reported, and we know from past reporting seasons when a company comes out with a result that's better than expectations, not only do you usually see this positive halo over the share price 6 weeks later, but also 6 months down the track. So hopefully their run-up can continue. Now, Nathan did mention the US market, and it's a big one. It's 10 times the size of Australia. Can they make it over there? Their first profit over in the US. What do you think of Credit Corp, Kim?
Well, that's a really good question, Julia. I don't necessarily like the business that they're in because I just think that they're a better class of thug in a suit instead of carrying a baseball bat. I mean, they buy debt ledgers and they do a very good job at recovering the outstandings on it. 20% of their business is that, well, what you could loosely call, payday lending, perhaps that wallet wizard business. That is somewhat susceptible, but generally the core of their business is very good. I just hasten to add that the US is a very big market in terms of this debt collection business. They're not the only participant in it.
I mean, it's interesting because, Kim, I mean, you had the baseball bat analogy, but that's one of the reasons is why they've been making inroads into the US, not because of the baseball bat, but because they're perceived as being compliant and low risk by some of the larger financial institutions. Because in this area, if you're a big financial institution, you don't want to be playing with someone with standover tactics or that's going to put your customer base on.
Well, it's all about its reputational risk that's at play here. So, Credit Corp is very good at managing that whole process. And I think one of the reasons that they've expanded into the US is the Australian market has become quite competitive in debt ledger purchasing. So they're taking what they've learnt in the Australian market and are trying to apply that same model to the US. And, hopefully that will work for them.
$30 valuation, almost 50% upside from here. What do you think of that number?
Yeah, I mean, in terms of the recent share price appreciation, obviously we had that research report out a couple of months ago.
This is the Checkmate one that the share price dived 20%.
Share price took a dive. A particular firm sort of loosely put together some reasons why it should be a big short, but that looks like it was used as a buying opportunity by the market. But it was still at a depressed level when they released their results, because at the end of the day the results were slightly under expectations, but I think because it was coming off a low base, we saw that nice lift up in the share price. It's sort of back towards the top end of where it's previously traded, so I can maybe see $1 or $2 upside short term. Whether it gets to $30, it's hard to see that at the moment. I think in terms of headwinds for the company, in terms of bad debts and delinquencies, we're still in an environment where growth is still pretty good here and in the US. Interest rates are low. I think if we really started to see an uptick in interest rates and that putting pressure on consumers.
Here's one out of left field. How does the disintermediation of all the different fintechs affect the credit card companies who traditionally have generated these books of ledgers or these debt ledgers for these types of people? So Credit Corp in 3 to 5 years might be dealing with a completely different
fintech instead of the financial institution. Someone that can't pay their bills.
Yeah, but it might be a completely different business environment that it's dealing with a different set of ledgers and different business dynamics.
Okay, let's go to my favourite segment. That's getting our panellists buy, hold, and sells. We're going to start off with Kim. Kim, you have a couple of buys today.
Julia, I'm sticking with a couple of favourites. I don't know whether they are darlings, but I've spoken about these in the past, and it's BHP and Rio. Now the new reasons for both are basically just returns to shareholders. We're now looking at both BHP and Rio potentially spinning off in IPOs some of their iron ore assets. So if that were to happen with BHP, that would be a big plus, because we saw what's happened with the spin out of the assets that happened with S32, and that's been quite successful. Same thing with Rio. So I'm looking at a period where you're going to get extended shareholder returns out of those two, which will beat the rest of the market.
Okay, so returns back from BHP and Rio Tinto. Michael, what are you buying?
I like the look of Seven Group. So Kim mentioned Seven West Media. So Seven Group has the code SVW. This is the company. Obviously, they have holdings in Seven West, but Seven Group has holdings in Coates Hire and WestTrac. So we've got increased infrastructure spending. They upgraded their guidance in May. It's a great looking chart.
It's a fantastic looking chart.
Brilliant.
Yeah,
Still happy
I
to
think
buy
there's
in
further
here?
upside. Yeah, it consolidated for the last several weeks, but just in the last couple of weeks, we got the buy signal and now it's on the move again. So I think there's further upside there.
Okay, so 7 holdings in that engineering construction space. What's your sell, Michael?
One chart that grabbed my attention today is Adelaide Brighton, ABC. It seems to be really struggling here. It peaked, I think it was a couple of months ago and came off, and then in the last week or two it's tried to recover, and then it's just been belted down again. So they report in a week and a half's time. I had a look at all the broker targets. On average, they're about 8% under where it is now. So this might be one stock that's overshot.
I think you could be right there, because I think one of the
Awesome.
real tests this reporting season are going to be some of these housing-related stocks that are exposed just to the Australian economy, because we know where the pain has been. And Adelaide Brighton is probably one of those ones that fits the bill there. So it'll be interesting getting the result out of Adelaide Brighton. On that note, we hope you've enjoyed the program tonight. A big thanks to my guests, Michael Gable from Fairmont Equities, as well as Kim Slater from County Securities. And a reminder, you can watch the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au. And if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program